Welcome to Money and Markets Series 4, Lesson 2. This lesson is called Investment and Commercial Banking. In Lesson 1, you met the central bank, the institution at the top of the chain that sets the policy rate. Now we move down the chain to the banks that actually touch your money. There are two main types. Investment banks, which help companies raise capital, trade securities, and advise on deals. And commercial banks, which take your deposits and lend them out. For most of modern history, these two types were kept separate by law. Then that law was repealed. And less than a decade later, the financial system nearly collapsed. This lesson covers what each type does, how they differ, how they merged, and what went wrong when the boundary disappeared. Investment banks have 6 distinct functions. First, underwriting. When a company wants to issue bonds or stock, the investment bank guarantees the sale. It buys the securities from the company and sells them to investors, taking on the risk that the market might not absorb them. Second, IPO issuance. When a private company goes public for the first time, the investment bank manages the process, pricing the shares, marketing them to institutional investors, and listing them on an exchange. Third, sales and trading. Investment banks buy and sell securities for clients and for their own accounts. This is the market-making function you learned about in Series 3. Fourth, research. Analysts at investment banks study companies, industries, and economies, then publish reports that help investors make decisions. Fifth, securitization. Banks bundle loans, mortgages, car loans, credit card debt into packages and sell them as securities. This moves risk off the bank's balance sheet and onto investors. Sixth, mergers and acquisitions. When one company wants to buy another, the investment bank advises on valuation, structure, and negotiation. 6 functions. 1 institution. That is the investment bank. Investment banks also provide credit, and that means they need to measure it. For businesses, the bank evaluates financial statements, cash flow projections, and industry conditions to assign a credit rating. Higher rating, lower borrowing cost. Lower rating, higher cost, or no credit at all. For individuals, the process is distilled into a single number. In the United States, that number comes from FICO, the Fair Isaac Company. Your FICO score ranges from 300 to 850. The score considers 5 factors. Payment history, do you pay on time? Amounts owed, how much of your available credit are you using? Length of credit history, how long have your accounts been open? New credit, have you applied for many new accounts recently? And credit mix, do you have different types of credit? That single number is available to every lender you approach. Credit card companies, mortgage banks, landlords, auto dealers. Without FICO, every lender would need to conduct its own assessment from scratch. The score makes credit markets scalable. Your FICO score is, in a very real sense, your financial reputation reduced to 3 digits. Banks also provide an array of fixed-income products across different maturities. Short-term means less than 1 year. This includes commercial paper, unsecured promissory notes that large corporations issue to fund day-to-day operations. It includes certificates of deposit, which you already know well. And it includes treasury bills, short-term government securities. Intermediate term means 1 to 10 years. This is the territory of treasury notes and medium-term corporate bonds. Long-term means more than 10 years. Treasury bonds, which mature in 20 or 30 years. Long-dated corporate debt. Mortgage-backed securities with decades of cash flows. Each maturity carries different risks and different returns. Short-term products are generally safer but pay less. Long-term products offer higher yields, but expose you to more interest rate risk, the seesaw you learned about in Series 3. This maturity spectrum is the shelf of products that banks make available to both borrowers and lenders. And the rates on every product trace back to the policy rate that the central bank sets. Now the bank you actually walk into. The commercial bank. Commercial banks take deposits from the public and lend that money out to individuals and businesses. You already understand this model from Series 1 and Series 2. Deposits flow in, loans flow out, and the spread between deposit rates and loan rates funds the operation. For most of the 20th century in the United States, commercial banks were highly regulated and deliberately separated from investment banks. That separation came from the Glass-Steagall Act of 1933. Passed during the Great Depression, the law drew a clear line. Commercial banks could take deposits and make loans. Investment banks could underwrite securities and trade. But no single firm could do both. The reason was simple. Lawmakers believed that banks holding ordinary deposits should not be gambling with that money in securities markets. Deposit taking is a public trust. Trading is a private risk. Mixing them, they argued, was dangerous. Glass-Steagall had consequences. JPMorgan, one of the largest banks in the world, had to cut its services. It could no longer offer both commercial and investment banking under the same roof. Revenue streams were severed. Banks tried to work around the restrictions. Some created holding companies, corporate parents that owned both a commercial bank and an investment unit, technically separate but closely linked. The Bank Holding Company Act of 1956 gave the Federal Reserve more oversight of these structures. But the pressure to merge kept growing. Banks argued that the separation was outdated. International competitors, particularly in Europe, faced no such restrictions. American banks were losing market share. In 1999, Congress repealed Glass-Steagall. The Gramm-Leach-Bliley Act allowed commercial banks, investment banks, and insurance companies to combine. Today, JPMorgan Chase is among the largest commercial banks in the United States and one of the top underwriters of IPOs. The wall is gone. Less than a decade after the repeal, the financial system nearly collapsed. The subprime mortgage crisis of 2008 is one of the most studied events in financial history. And the story runs directly through the concepts you have learned in this series. Here is what happened. Commercial banks and companies that behaved like banks, like Countrywide Financial, made mortgage loans to borrowers who could not afford them. No down payment. No proof of income. Adjustable rates that would reset sharply higher after a teaser period. These mortgages were then bundled into securities by investment banks, the securitization function you heard about earlier. Those securities were sold to investors around the world as if they were safe. When housing prices stopped rising, borrowers defaulted. The securities lost value. And the institutions holding them, banks, insurance companies, pension funds, faced catastrophic losses. Countrywide Financial, under CEO Angelo Mozilo, is the case study. It pumped out mortgages to borrowers who did not understand the risks, then packaged them and sent them to Wall Street. The company did not care what happened after the borrower signed, because it had already passed the risk along. Did the repeal of Glass-Steagall cause the crisis? The debate continues. On one side, repealing the wall allowed commercial banks to invest heavily in mortgage-backed securities. Without that consolidation, the damage might have been contained. On the other side, several of the biggest players in the meltdown, Lehman Brothers, Bear Stearns, Goldman Sachs, were never commercial banks. They were pure investment banks. Glass-Steagall would not have restrained them. And there is a third argument. Some historians point to the Department of Housing and Urban Development, which pushed Fannie Mae and Freddie Mac to purchase more affordable mortgages. That policy encouraged lenders to lower standards. And many of those lenders, like Countrywide, were not even traditional banks. They did not accept deposits at all. The truth is probably all three. Regulatory repeal, Wall Street incentives, and government housing policy each contributed. No single cause explains everything. What is clear is this: when institutions that hold ordinary deposits also take on complex trading risks, the potential for catastrophic failure grows. That tension between public trust and private risk has not been resolved. For takeaways from this lesson: 1. Investment banks have 6 functions: underwriting, IPOs, sales and trading, research, securitization, and mergers and acquisitions. They help companies raise capital and they make markets. 2. Credit scoring, like FICO in the United States, reduces a borrower's creditworthiness to a single number between 300 and 850. That number determines your access to credit and the rate you pay. 3. Commercial banks take deposits and make loans. For decades, the Glass-Steagall Act kept them separate from investment banks. That wall was removed in 1999. 4. The 2008 crisis showed what can happen when the boundary between deposit-taking and risk-taking disappears. Countrywide, Lehman Brothers, and the subprime pipeline all played a role. The debate about what caused it continues. Next lesson, we revisit risk, but with sharper tools. Market risk, reinvestment risk, inflation risk, and credit risk revisited. Then we close with the places where all of this trading happens: exchanges and over-the-counter markets. I will see you in Lesson 3.